So today, Adam's going to take us through how we evaluate alternative investments, whether or not we should include them in our portfolios. I hope you'll hang on through a few of the dry parts, because if you can really grasp this concept, I think it can be life-changing for you in your financial lives and your financial decisions. Have a great day. Hope you enjoy.
Hey everyone, it's Adam with Castle Point. I wanted to take you through today our framework that we use to evaluate different investments to determine if they're suitable for being held in a client's portfolio. And I wanted to use an example to walk through this framework and decided cryptocurrency would be an interesting one. That's obviously a hot topic lately. A lot of people are interested in cryptocurrency and learning more about it. We get a lot of questions about it as well. So we're going to take that through our same framework we would use to evaluate stocks, bonds, insurance products, all kinds of other financial assets to sort of help explain what our process looks like when we recommend something for a portfolio. So if you look up here, the first thing that we always kind of bucket the asset by is what are its expected cash flows. So in the positive category, you think about things like traditional businesses, right? They generate income and they use that income to pay dividends out to shareholders. Or if you own a small business, you know the business generates income. So ultimately, it can send some of that income back to you. So this is probably the most traditional investment, has a positive expected future cash flow. You can also think of lots of investments that have no expected future cash flows. So gold, commodities, cryptocurrency would fall in this bucket, where the cryptocurrency is not going to send you a check someday. It's not going to send you a dividend. The way that you would earn a financial return from cryptocurrency is it would have to go up in value and then you sell it. And you can have one cash flow and it's the time you sell the asset. The asset in and of itself is not creating cash flows. And then over here, you have products with negative expected cash flows. Probably the best example of this is insurance, right? Like when you pay insurance premiums, it's not because you're expecting that you're going to claim more in benefits than you're going to pay in premiums. Usually you're doing that because you do expect to pay more premiums over your lifetime than you will receive in benefits. You don't expect your house to burn down. You don't expect to be in a major car accident. But you understand that the financial risk related to those incidents is large enough that you'll pay a little bit of money to make sure that you mitigate that risk. And so insurance is an example of an asset with negative expected cash flows. Once we've got the cash flow thing figured out, the other thing we look at is, okay, what's the purpose of holding this asset? So the most obvious one is why you buy most things that you buy: consumption or enjoyment, right? Like I don't buy a ham sandwich because I think it's a great investment. I buy a ham sandwich because I'm hungry. All kinds of things fall into this consumption or enjoyment bucket, including things like cryptocurrency, maybe individual stocks. You enjoy picking individual stocks, things like that. The next bucket up is risk management. And so this is not where we're trying to seek a financial return, but we're trying to offset some risks somewhere in your life that you don't have the ability or willingness to bear. So home insurance is a great example. And in fact, if you have a mortgage with a bank, they're probably going to require you to get homeowners insurance because they want to manage the risk of your home being destroyed and their collateral not being worth anything. So risk management is one other reason to hold assets. The final one is inflation-adjusted financial returns. So this is kind of the traditional thing you think of as investing. So you are putting money into something because you hope to get more money out of it someday in the future. And so if we think about where cryptocurrency falls, it's in the middle category. There are no expected cash flows from cryptocurrency, again, other than ultimately selling it someday. And so then if we think about the reason why we might hold it, you can hold anything for a consumption enjoyment. That's always a reason you might want to hold something. Risk management, if I think about cryptocurrency, the most compelling kind of reason you might hold cryptocurrency from a risk management standpoint is because you think that long term, it's going to be a really good hedge against inflation. Potentially, that would be one risk management reason to hold cryptocurrency. And then finally, you could hold cryptocurrency because you expect an inflation-adjusted financial return. The difficulty there is we don't have a super strong premise of why cryptocurrency would create a inflation-adjusted financial return over the long term. And that leads us really well into kind of the second step in our analysis is, say that we wanted to conclude cryptocurrency was going to create an inflation-adjusted financial return, or that cryptocurrency was going to be useful from a risk management perspective. We have to ask ourselves, what would we need to see to conclude that? And this is where we're going to look at both data and theory. And ideally, we want to see an investment with super strong data, a long track record of delivering positive expected returns, and where we can really understand the theory of why. Why would that investment create positive returns? So stocks are a fantastic example where we have 100 plus years of public market data on publicly traded stocks. And also, we have a really strong theory of why stocks create returns for investors long term, because ultimately those stocks are pieces of companies that produce the goods and services in the economy. And so as long as people are inventing things and as long as the economy is growing, companies will capture some portion of that growth and be able to pass that on to shareholders in the forms of dividends or stock buybacks. So if you ask yourself cryptocurrency, where would this fall on this table? Again, thinking of it both in this bucket, will it produce an inflation-adjusted financial return? And this bucket, is it going to serve a useful function for risk management in our portfolio? So on the risk management piece, cryptocurrency would be all the way over here. So if we want to think about cryptocurrency as a potential hedge for long-term inflation, the data, in the past few years has actually shown that it behaves a lot more like a risky asset. Cryptocurrency is much more correlated to the overall market performance than it is to any inflation metric. And even if there was strong data that correlated to an inflation, we just really haven't seen enough data, right? So cryptocurrency has been around for, probably 10 years or less. That seems like a long time in human time, but in terms of data sets for how markets behave over an investing life cycle of 20 plus years, that's not a lot of data to look at. So we would have to assess that cryptocurrency, the data for it, for both, serving as a long-term hedge against inflation and as serving, as part of this part of the portfolio, inflation-adjusted financial return. We really just don't have the data to say that it's there. Now, that's not a slam dunk reason not to hold it, but it should bias us against, holding it if we don't see strong data. Now, in the absence of data, or even when data is there, we also look to see if there's a good theory of why an investment might behave a certain way. And this is where we come back to the concept of cash flows. So from a theoretical perspective, what would drive cryptocurrency up in value? And it won't be the growth of the economy, right? So for stocks, the growth of the economy is going to just mechanically drive up stock values over time because people will continue to invent things, the economy will grow, and that all kind of just mechanically flows through to stocks in the long run. Cryptocurrency, there's nothing, about economic growth that inherently means that cryptocurrency is going to get larger. It's really a matter of whether or not the technology is adopted, whether it displaces dollars and other forms of currency. That could happen, but there's not, an underlying theory of why it has to happen. And so that's the reason that we do not recommend cryptocurrency as a component of your portfolio for seeking inflation-adjusted financial returns. For that, we really want to lean on stocks and bonds, things that, our crystal ball gets really hazy past a year, 2 years, 3 years, 4 years, 5 years. When you're talking about 20 plus years of investments, it's really tough to know what the next technology is going to look like. If you think back to, 20 years ago, the iPhone wasn't invented. The smartphone revolution hadn't come and wasn't even particularly close to coming yet. So it's really tough to imagine what the dominant technology might be in 20 years. On the flip side, the economy will probably still work very similarly in the sense that, economic growth will accrue to companies, and those companies will pass on those gains to shareholders. So we've got a really strong theory and data underlying stocks and bonds. We have basically no data and no strong theory underlying why cryptocurrency would produce inflation-adjusted financial return. But what about risk management, right? So we go back to here. We already talked about the data is just really not there to be able to correlate cryptocurrencies as being a good hedge for inflation. But what about really long-term inflation? What about inflation over the period of 30, 40 years? Well, the data is not there because cryptocurrency hasn't existed for that long. But do we have a theory there? And I would say we have a weak theory there. So I could see how, if cryptocurrency becomes a dominant currency, how that might be one way to offset inflation in dollars or inflation in other foreign currencies. So the question is, do we feel strongly enough about that theory to include cryptocurrency as part of our portfolio from a risk management perspective? And I would say the argument there would be we have much more reliable ways to hedge inflation over long time periods. If we have a really high level of concern about inflation, to some extent, stocks can serve as a hedge there, real estate can serve as a hedge there. There's certain inflation-linked bonds that mechanically serve as a hedge in that space that we'd feel really good about hedging inflation, although they would have a pretty low financial return. So that's kind of where cryptocurrency would fall out in this framework, is just not enough data here and not an underlying theory here as to why it would produce an inflation-adjusted financial return. And for risk management, maybe there's a very weak theory there that it could hedge against inflation over the long term, but just not a strong enough theory to put it ahead of alternatives for that purpose. And definitely not enough data. Hopefully that was instructive. There's more steps that we go through. We look at the holding type, if we can get diversification, the type of market the security trades in. We look at kind of the alignment we have with the manager of the fund or the security. Transaction costs are really important. All kinds of other stuff, tax treatment, tax certainty. But for cryptocurrency, it's really these first two steps where we make the majority of our evaluation in determining. It's an interesting asset. It's definitely something you could hold individually just because you're interested in it, but probably not something we would consider a core part of the portfolio to generate a financial return, and just not really a compelling case there to use it for risk management either. So hopefully that was helpful, give you a little insight into how we make decisions and how we think about different investments. And we'll do more of these in the future with other assets and go through the rest of the framework, but wanted to kick it off with probably the most interesting asset out there that we get asked questions about, which is cryptocurrency.
Thanks everyone for taking the time to watch these videos. I really hope they're helpful. If you have any questions or concerns or things you want us to talk about, please give us feedback in the comments section. You can email us, whatever's the best way for you. We're seeking feedback. We do these only for you, and we hope they provide great value. If you are getting value, please hit like and subscribe, and turn on your notifications so you're notified when new videos come out. That definitely helps our channel out, helps us spread the word and help more people. Thanks a lot. Have a great day.